Panic, volatility and risk-off best summarize the Friday session from the very early hours of trading here in London. As Britain voted to leave the European Union, we watched the pound losing more than 10% against the US dollar. The FTSE futures traded almost 9% lower in Asia. The euro pound cleared the 0.80 resistance and hit 0.80 141 level. The rush toward the safe haven assets sent gold prices to $1,358 level. The yen traded at 99 per dollar as Nikkei stocks write off 7% in Tokyo. The UK's Prime Minister David Cameron resigned right after the results, adding another layer of panic to the markets as his resignation was not expected as soon and was clearly not priced in. A period of a great political, financial and economic uncertainty has just started. A quick glance to the geographical picture suggests that London, its surroundings and Scotland voted to remain in the European Union, while the rest of the United Kingdom preferred to walk out. This picture will likely bring forward the risks of another Scottish referendum and could cause a further political uncertainty at the heart of the UK, on top of the looming worries regarding the European Union. Moving forward, attention will shift to the Bank of England. The markets could need a hand to go through this historical decision. Some measures could be put in place if we see an excessive volatility in the pound, the stock and the bond markets. This being said, given the low to negative rate environment in the UK and across the Eurozone, the BOE's maneuver margin is disturbingly narrow. And Bank of England's Governor Carney said to wait and see before intervening in the market. Next week, the UK will announce the final gross domestic product growth for the first quarter. Any disappointment could further dent the appetite in the markets. To summarize, political and financial uncertainty, high volatility, choppy market conditions are on the menu of next week. We remind that the volatilities could be two-sided. Wild swings in the mood is what traders should be prepared for. Despite waves of upside correction and short-term rallies, the UK markets and the pound are set to remain downbeat. Now, enough said for the UK. In the United States, traders will be watching the US GDP growth on Tuesday. The US GDP may have grown by 1% according to the consensus versus the previous release of 0.8%. The US dollar has recently rallied across the board as the Brexit vote sent many traders in the arms of the US dollar safety. Now, of course, with the Britain leaving the European Union, the expectations of a July rate hike are mostly off the table. The market gives no more than 10% probability for a rate hike to happen next month, and there is a 50% chance for a rate hike to happen before the end of this year. Therefore, once the Brexit euphoria and the risk of sentiment is over, we could see a pullback in the US dollar against majors. Finally, on Friday, Japan will release the inflation figures. The national CPI ex-fresh food, so the one that the Bank of Japan monitors carefully, is expected to have further dampened to minus 0.4% from minus 0.3% a month ago on year-on-year basis. The sharp appreciation in the yen following the Brexit vote is of course an issue for the Bank of Japan. We may possibly hear some speculations on a further monetary stimulus from Mr. Kuroda and expect the US dollar JPY to recover to 108-110 zone, which stand for the 50-day and 100-day moving averages respectively. Good luck trading.